Hello, everyone, and welcome to today's event for Equity 101, Cap Tables for Basics for Founders. My name is Zachary Rainey, and it is a pleasure to be able to speak with you today. Kind of while we're all filing into the webinar, I just wanted to thank everyone so much for being able to join us today. This is kind of one of our most highly anticipated webinars that we've had to date, and we're really excited to be able to share this information with you. Just letting you know kind of who we are and what we do. Passport is the most comprehensive digital innovation platform connecting entrepreneurs, emerging startups, and with access to vital resources, networks, investors, and essential business tools through Passport OS. People who are using Passport have access to over 175 mentors. We have tons of investors in our network and over 1 million plus in perks through our perk partners, one of which will be actually Savvi Legal. Just to let you know, kind of a couple of our speakers today, we have Jeff Erickson, and also we have Dan Roberts. Jeff currently serves as the Director of Business Development at Carta. He's a leading software company. That's a leading software company that helps investors, companies, and employees manage their equity. He loves working with entrepreneurs and currently serves on the advisory board of several startup companies. And we also have Dan Roberts. He is the co-founder and president of Savvi Legal. Prior to Savvi, Dan was an attorney at the Hunt & Andrews Kurth LLP, where he worked with hundreds of VC firms, accelerators, startups through the country. Dan has a BS in biochemistry for Brigham Young University, where he graduated a magna cum laude with honors. I would like to welcome them both to the stage. Thank you, gentlemen, so much for being able to join us and being able to host this webinar. If you would like, please go ahead and share your screens for me, gentlemen, and I'll pass the baton over to you.
Zach, thanks so much. It's a privilege for Dan and I to be here and part of the OneValley community. Really appreciate it. Dan and I love working together. Dan brings the legal side and also the founder side, which is really unique and very cool. As Zach had mentioned, I'm also a founder and startup advisor, mentor, and an angel investor, and so it's kind of a fun mix between Dan and myself. So as Zach mentioned, we're going to talk a little bit about Equity 101, equity basics for founders. And to kick things off, Dan, anything you wanted to add to that before we kind of jump into things?
No, just excited to be here. Happy to hear you talk, Jeff. Jeff knows what he's talking about when it comes to equity, and we're excited to bring this presentation to everybody in the OneValley community.
Awesome. Well, with that, we're going to start with the very basics. So, I mean, if you're an early stage founder, this is your first time, around. We'll cover a lot of the basics, and then Dan and I plan to stick around afterwards and open up for a Q&A if you guys want to dive a little bit deeper into things. To kick things off, when we're talking about equity in your companies, we're talking about ownership. And so when you think of ownership of your company, there's an economic ownership component and there's a governance ownership component. We're going to be focusing specifically on the economic ownership. And what we mean by that is, as an investor gives you an investment, they will take a percentage of the economic ownership of your company. At the same time, you should be aware of the governance aspect of ownership in terms of, as you start to give up board seats and what that means, voting rights, things like that. We won't get into that, but do understand that that is a critical component of ownership as well. So with that, we'll start off by talking about how economic ownership kind of works and diving into the difference between common shares and preferred shares, something that you'll run into early on as a founder. When you first start out your company, you've probably already set things up. Just to kind of go back, whether you're set up as a C Corp an S corp or an LLC, the principles will all be the same. We're going to talk specifically about C corps when we're talking about shares. If you're set up as an LLC, the same concepts would apply. You'd just be dealing with units instead of shares or membership units. But don't get too confused on that. So when you're talking about common shares, this is typically what you as a founder are going to receive when you're starting a company. And what we mean by common is that these are the shares that get paid out last if there's a liquidation event. And so after all of your investors and everybody else has been gotten their investment back and potentially a return, the common shareholders are the ones that are last to participate. So this is what will typically go to you and your employees. Your preferred shares are what typically go to your investors. And I'll let Dan talk a little bit about preferred shares here.
Absolutely. And just to be clear, common shares, although they get paid out last, it doesn't necessarily mean they get paid the least. Common shares represent the residual value, as Jeff mentioned, after anybody with a preference is paid out first. And so when you're raising money through an investment, investors typically want to have a liquidation preference on their shares, and to get that preference, they're issued preferred stock. And that isn't to say that they'll get paid more. Usually the preferred stock is set up so that the preferred can choose to get paid the same as the common. And if the common ends up getting paid more than the preferred would pay out, then the preferred will get treated like common shares. But the preferred stock just allows you to set up certain preferential rights and more detailed investor rights. And that's why investors will typically get preferred stock.
Great. And one way I look at it a lot of times, Dan, is where the investor is putting their money in, and they don't want to put in $1 million and then just have the founders take that and leave. So there's a preference put in place to say, okay, we need our $1 million back first. If you're going to liquidate the company, one day later, we need our money back first, and then the common shareholders can participate. So it's kind of a protection for investors as well. Makes perfect sense. So the other thing that you're going to run into early on is a conversation about convertibles or convertible notes or safes. A safe is a simple agreement for future equity, and there's some differences between a convertible note and a safe, but the concept is very similar in that you're not necessarily issuing equity right up front, but a promise for future potential equity down the road. So some of the things that you'll run into with convertible notes, typically you'll have a maturity date and an interest rate attached to a convertible note, where that's not necessarily the case with a safe or simple agreement for future equity. Safes are becoming more and more common. So you are seeing that, especially like in Silicon Valley and some of the hot spots for startups. But you will have investors that sometimes require you to go through a convertible note, which can be a little bit more advantageous for the investor because you do have a maturity date associated with it, and they could potentially call that note at the maturity date and say, we want our money back. So anything to add to that, Dan, in terms of kind of maybe even differences between safes and convertible notes?
No, I would say that typically in the industry, we see convertible notes as more investor friendly, just because they do have an interest rate, which is it's adding to the shares that the investor is eventually going to get when they do convert. They have that maturity date, which puts a kind of a time period, a little bit of pressure on the founder to go and raise money by a certain period of time. Whereas with a safe, you don't have either of those. The other thing, to keep in mind with safes and convertible notes is there are other subtle differences between different types of safes and convertible notes, where you might have a pre-money safe versus a post-money safe. We're not going to get into the specifics here of those different terms, but they do impact the dilution that the founders take. in those different terms. But all kind of things taken equally, convertible notes and safes are a simpler way for a founder to raise money than preferred stock because there are fewer terms to negotiate, fewer investor rights attached to them.
Great. Yeah. The one thing that I have run into with convertible notes is there is the potential risk that, if the investor did call the note and say, the maturity date's up and we need our money back, that they could shut the company down. Now, typically it's not in their best interest to do so, right? Because they're probably not going to get their money back if it's not there. But what I have seen could happen is that they could take the IP from the company in that case. And so it is a little bit more friendly in terms of protecting the investor on their investment. And so that's sometimes why you'll see investors say, we want to do a convertible note instead of a safe. Okay, so the other thing that you're going to run into as you start to bring on advisors and new employees, you'll run into stock options. And stock options are something that you would set a strike price for, and the employee or advisor would have the option to buy the stock at a later date down the road for that strike price. So the intent is that the company will be worth a lot more when they do eventually exercise and sell their shares. With stock options, there are two types you need to be aware of. And the first is an incentive stock option. And this is what goes to your employees. Your incentive stock options, or ISOs, you'll hear the term, they have beneficial tax treatment for your employees. And that's the main difference between your ISOs and what are called NSOs, or non-qualified stock options. Your non-qualified stock options are what typically go to your advisors or non-employees that you might be issuing stock options to. And they do, again, the difference is that they don't have the special tax treatment that your incentive stock options would have. The key here being that you have to keep track of which ones are ISOs and which ones are NSOs. And there are some limitations in terms of how many ISOs can go to an employee in a year and some things like that. So it is important to keep track of that.
And I'll just chime in here. The ISO benefit, the tax benefit, is very impactful for those who receive it, because what it means is that when you exercise your stock options, you don't owe taxes at the time of exercise. Meaning that's the point of time where you're purchasing the shares, and you don't have to pay taxes based on the increased value of those shares above the strike or exercise price. And so there is a good, an impactful tax benefit, but there are definitely rules you need to follow to make sure you can take advantage of ISO treatment. They're kind of hard for a founder to keep track of, and so you'd want a good software tool to keep track of that for you, which is where Carta comes into play. But you also have to have a stock option plan that's been adopted by the board, adopted by the shareholders, and in place where you can grant these stock options from. So just a few points with regards to issuing stock options.
Yeah, great points, Dan. Great points. Okay, one of the other things that you'll run into as you start to issue stock options, you'll come across a term of a 409A valuation. It'll probably be your attorney or somebody will say you need to get a 409A valuation. One point of clarification I want to make here that a lot of founders get confused on is that your 409A valuation is simply a compliance valuation for the IRS. And so the IRS wants to make sure that you're not setting the strike price of your stock options too low. So your 409A valuation is typically done by a third-party provider that will come in and set and say, this is what your common shares are worth. And you typically want that to be low because that will benefit your employees as you try to attract top talent, and they want a low strike price on their stock options. So it's interesting that a lot of founders think that their 409A valuation is what the investors are going to look at. This does not have impact on your valuation in terms of what the investors are going to see. In fact, the investors know that you want a low 409A valuation they're going to look at the valuation based on the company in terms of other factors and in terms of how much they're willing to put into the company and the terms on the term sheet. So the key here is that your 409A valuation is very different from the valuation that an investor is going to place on your company. Two very separate and distinct types of valuations. Any clarification there, Dan, from your end?
Nope, I think that you kind of hit it spot on. You typically are going to be getting 409A valuations once you've started raising money or started having, significant revenues where you can point to there being some value attached to your stock. Most companies, when they're first starting out, don't get a 409A valuation before they've raised money or started selling any products, just because the value of your stock is pretty easily determinable as, very, very low at that point, 0.001 per share or something along those lines. And so the 409A does kick in. You really want to start getting those when you start issuing stock options after you've started raising money or had revenues. And I will say that 409A valuation is good for a 12-month period. You don't have to get this every time you issue stock options. It's good for 12 months or up until the next financing event. So.
Yep, great clarifications. Okay, the other thing that's going to be associated with your stock options, and also hopefully your founder shares as well, are vesting schedules. And it's interesting, as I talk to a lot of founders, sometimes they feel like vesting is unfair because it's their company. But I think if you switch this around and say vesting is your friend, because the last thing you want as a founder is to split up the company between two other co-founders, so you all own a third of the company, and then 6 months into it, one of the founders says, look, I can't keep doing this, you guys, good luck, we'll see you later, and they walk away with a third of the company, and that's just not fair. Same concept with employees is you don't want to give employees a percentage of the company, and then 3 months later they leave and they take that percentage with them. And that's why you put a vesting schedule in place where they're earning their shares over a period of time. Typically, investors are going to require this for your founder shares because they want you guys to stick around as founders, and they'll require it for your stock options very typically as well. And so you'll want to put a vesting schedule in place. Again, one of the keys here is that you need to keep track of the vesting schedules. You'll have employees, that are on different vesting schedules at different times. They might have different periods that they're vesting their shares over. So it's important to keep track of it all. The other thing that I'll just mention is that probably the most common vesting schedule you see out there that's become fairly standard is a 4-year vesting period for employees with a 1-year cliff, meaning that if the employee leaves in that first year, they wouldn't be entitled to any of their stock options. And so that's become very common, and typically it'll be like a monthly vesting cycle where your employees are vesting 1/48 of their shares each month, and then at the 1-year mark they would receive 25% of their shares all at once, and then start vesting monthly from that point. So that's what we see probably most commonly, but I mean, you can set up your own vesting schedules to what makes sense for individual employees. Dan, any thoughts on vesting from your end?
Yeah, I will mention a lot of companies start talking to contractors or advisors or employees, and they kind of determine, what, the best way for me to grant this person equity would be if they hit certain milestones, and so what we call performance-based vesting. And what I'll say to that is it complicates your cap table to have to keep track of milestones for every equity grant. And you can actually accomplish the exact same incentives with more flexibility using time-based vesting, like the 4-year, 1-year cliff vesting schedule. Because what you do is you tell that person, say, I'm going to grant you this number of shares, And you're going to get these shares if you continue to hit your targets that we set for you, because if you're not hitting your targets, you're going to leave the company. We're going to fire you, and then you're not going to vest in your shares. And so instead of, if you are thinking about doing milestone or performance-based vesting, I'd encourage you to keep it simple. Do a time-based vesting schedule that's easier to keep track of, and then just tell them, hey, we're going to set employment targets for you, that if you're not hitting these targets, you're not going to vest in your shares because you're not going to be with the company. It's just going to be simpler from your end to keep track of that. And then it also allows you to be more flexible, because if you were thinking, hey, you're not going to get your shares unless you hit $1 million in sales, but then let's say COVID happens again, and that salesperson isn't able to hit their targets, but you're still very pleased with them. They've been working hard. They've been selling. That performance-based vesting might turn them off, and they'd say, well, there's no way I can get my shares, so I'm leaving. Instead, with time-based vesting, you can say, well, we didn't hit our milestones, our targets, but we want to keep you employed, so you are going to be able to get your shares regardless, because we are pleased with the job you've been doing. So that's just a plug to say time-based vesting accomplishes the same incentives, allows you more flexibility, and it's easier to keep track of than performance-based vesting.
I love your perspective, Dan. I mean, you've seen so many companies deal with this. It's great to have your perspective just from experience on things like that. So awesome. Thanks for sharing. Okay, so as we pull all of this together, you start to wonder, there's all this stuff to keep track of as you start to issue out equity. You as founders and your early employees are going to receive your common shares, and then you start to get an investor, friends and family that come in, and maybe they require preferred shares, and then maybe you start to look at convertibles, either a SAFE or a convertible note that you start to issue, and then you start hiring employees, and you get employees coming in and advisors and issuing stock options, having to keep track of whether they're ISOs or NSOs. And then you've got vesting schedules associated with all these things, and you need to keep track of that. And you can see as the company starts to grow, you start to issue more shares and have more stock options, more vesting schedules. It can get really complicated very quickly. And so, the question is, how in the world do you keep track of all of this stuff? And this is where we get into the concept of the cap table. So you've heard of a cap table. In its simplest form, the cap table is really meant to keep track of your equity in the company and how it changes over time. Dan, I'll let you talk to the cap table here for a minute.
Absolutely. So the principle with a cap table, as Jeff said, is really to be able to keep track of the different moving pieces and parts of the ownership of your company. Obviously the key pieces of it is keeping track of who holds what shares, what class of shares, and the number of those shares. So that's the basics of it, but there's a lot more that goes into it. You will often see in cap tables, you will see certain words like outstanding shares versus fully diluted shares versus authorized shares. And a cap table can keep track of all those different things, but you need to understand what those mean. And when we say outstanding shares, we are referring to stock that is actually held in stock form. Options, although somebody might hold options, those options are not outstanding shares, because an option is just a contract to hold future shares. So the options won't be reflected in your outstanding shares portion of your cap table. And SAFEs or convertible notes will not be outstanding shares either, because they have not converted into shares yet. But preferred stock, common stock, those shares are actually outstanding, so those are outstanding shares. Then you'll see the word fully diluted shares, and what that is that takes into consideration all of the shares that could be issued to anybody holding a right to shares right now. So options, somebody holds options, they hold the right to shares, and so those would be fully diluted shares, and you would count those in your fully diluted shares. If somebody holds warrants, that is also a contract to purchase shares, and that would be fully diluted shares. Typically, when an investor asks for your fully diluted shares, they're also asking for the shares that are in your option pool that may not be granted as options, because they want to know what is the maximum number of shares that could be issued right now by the company. And so they treat all of your option pool as fully diluted shares as well. And so when you hear the word outstanding, fully diluted, and you see those different columns on your cap table, that's what's being referenced. And you'll also hear the word authorized shares. Authorized shares do not have any impact on economics. They don't represent ownership. All the authorized shares means is this is a number that is in your charter, your certificate of incorporation, that's filed with the state that says, currently, this is the maximum number of shares a company could issue. And so authorized shares isn't actually a part of your cap table. It doesn't reflect or represent ownership, but it is a term that you may hear and may need to understand. But anyway, that's the cap table in a nutshell, showing who owns what of your outstanding shares and your fully diluted shares.
Awesome. Hey, Dan, one of the questions I get asked by founders all the time is, when I'm setting up my company, how many authorized shares should I put in there? I know you get asked that all the time too, because you do a lot of formations. So what do you typically tell them?
Absolutely. That's a great question. And you see a lot of kind of different schools of thought, but typically what you want to think about is, if you are a high growth company that's going to be raising money from investors, they will typically expect your outstanding shares for your founders and option pool to be somewhere around 10 million. That is very standard from the founders' shares to be issued. That's the number you're going to be shooting for, is 10 million shares outstanding to the founders and maybe to your initial option pool. It's just a very easy, nice round number, easy to calculate percentages. But your authorized shares, we typically recommend that you set your authorized shares a little bit higher than that, somewhere from 25 to 50% higher than what you're planning on issuing to your founders or your initial option pool, because you're always going to have more people to hire, advisors you need to issue shares to, and you need to have your authorized shares give you a cushion to allow you to issue more shares. Now, one thing you need to keep in mind is you don't need to authorize enough shares for your investors, because when you raise money from investors, you're going to amend your authorized shares. You're going to increase it to allow for that issuance. And so you don't need to keep that in mind. You don't have to be thinking of that when you set your authorized shares number when you form your company. You will amend it later. And in addition, you'll probably need to issue a different class of stock, a preferred stock, when you bring on your investors. And you don't know what those terms are yet, so you can't create that class of stock at the formation of your company. So just create a class of stock for common, authorize enough shares for your founders, for your initial option pool, maybe for the next 12 months of hires. Again, typically 25 to 50% more than what your initial issuance is. So rule of thumb that we give people is 10 million shares to the founders and option pool, and then authorize anywhere from 2 to 5 million additional shares. 15 million authorized common stock when you form your company is a very common authorized shares number.
Awesome. Yep, super helpful. Okay, so just a couple of cap table basics to reiterate some of what Dan already talked about, but your cap table is really tracking who owns how much of your company. It's going to show you things like how much equity does each founder own, how much money's been invested in your company over time, who owns what types of shares, keeping track again of the different classes like Dan was talking about. Dan mentioned the option pool as well. So you carve out a portion of the shares that would be allocated for giving stock options to new employees. So it'll keep track of that. It'll keep track of the valuation of the company at each funding stage as well. So you might ask, so why is it that the cap table is so important? As we get into this, it's funny how I've talked to a lot of attorneys, and I'm sure Dan can appreciate this, but they tell me that it's surprising how many times they have to remind founders that they only have 100% of the company to give away. And if they're not keeping track of things, it can get really easy to give away more of the company than you really should be. And so that's one reason that the cap table is extremely important, that you should be reviewing that, is to make sure, as equity changes, that you're seeing what those changes are. But it's also, if you skip down here to preparing for future funding rounds, you can use scenario modeling and tools to model out what the impact on your cap table is going to be after you take additional rounds of funding. And so being able to use your cap table for projecting out the impact of funding rounds is super important. Your cap table, again, it records all the changes in ownership over time. And so again, it's important to review that periodically. It'll also, your cap table is what's going to track your employee options, keep track of the vesting schedules and all of this stuff. But one of the important things that, or important reasons to keep your cap table up to date is it's amazing how many times investors get left off of cap tables, or that there are errors in the cap tables. And when your investors are making decisions on whether to invest in your company or not, they're relying on the data in your cap table to be accurate. If you've got some egregious errors in there that they make decisions on, that they're giving money to you, you can imagine what happens when a new investor shows up that should have been on the cap table and they weren't. And if they're a significant stakeholder, the impact that could have on the investors and what that can cause. I mean, lawsuits and all kinds of stuff. But then even leading into that, if an investor is looking at your cap table and they start asking questions, if your cap table is all messed up, it's going to create all kinds of issues for the investor, that we'll kind of get into here next. So with that, I wanted to talk a little bit about as you're talking to investors, what are some things in your cap table that might turn them off, and what are some things that they're looking at in terms of you as a founder and your company when they ask for your cap table? Because that's one of the first things they're going to ask you for when they're looking at seriously investing in your company. The first thing is they'll look for errors. So if you've got errors in your cap table, that sends a message to your investors or potential investors that, is this the right management team to be, entrusting our investment with if they can't even keep their cap table up to date? And so it is important to keep your cap table accurate and up to date. They will look for things like, your key founders or your founders and key employees, and whether you guys have enough equity left to keep you guys motivated through future funding rounds. And while there's things that you can do to kind of, rectify that, that is definitely something that they will look for and make sure that there's enough equity left for the founders to make it worth their while to invest in this company. They'll also look for things like who else is on the cap table. If they see unreputable investors that they wouldn't want to necessarily be associated with, that can definitely be a red flag and cause issues. They'll look for things like liquidation preferences, participation rights in previous rounds. Those will show up in the cap table, and they'll be able to see those and at the very least probably demand that they get treated with at least those same preferences or even better. But it kind of sets a precedent for you as you with your previous rounds. And then again, they'll look for things like, are things organized and making sure things add up and that your cap table is accurate. Dan, anything to add to that? You've seen a lot of cap tables, and I know you've seen a lot of messy cap tables and issues with them. Would love your perspective.
No, absolutely. As you pointed out, Jeff, the cap table is actually a very, very important part of investor due diligence. It's, they will, a lot of times they'll send you a due diligence checklist, and they'll kind of hand that off to their lawyers and say, all right, our lawyers will make sure you check all the boxes over here. but we need to see the cap table, and the investors themselves will look at your cap table because it tells so much about your company. It tells about the history of your company as well. And so there's a lot that goes into a cap table, and it's very important to investors. So I will just emphasize that. I know we'll talk a little bit here exactly on this next slide. It shows so much about what the history of the company is. Have there been, key employees who have moved on? Why did they move on? Was there a culture issue? Was it, problems early on with the company, or what is it? And how much of your company did they take with them with their vesting schedule? What did they have vested and unvested when they left? And what's left in your option pool? That is actually a very important point, a negotiation point for investors. They want you to reserve enough in your option pool for after their investment for you to go and hire some more people. And so they're going to ask you to increase your option pool if it's not big enough. And so they're going to be looking at all of that sort of stuff, the turnover in the company, other investors, how much they hold. All of that is very important to investors and how they look at companies.
Yeah, it's amazing. I don't think founders realize how much an investor, potential investor, can tell about them and their company by just simply looking at the cap table. You mentioned, are there potentially culture issues? Things like even, key employees that have left that didn't exercise their options, they might kind of dig into that and go, well, why? Did they know something that we don't know that we should be talking to them about? It can bring up all kinds of things. And then, it kind of goes back to the saying that, be careful who you let on your cap table. Because it can work for you or against you. Just like an investor might look for, unreputable investors that might be on the cap table that they wouldn't want to be associated with. If you've got some really good investors on there, that instills trust in your, potential investors as well. And so, looking for all kinds of things like that is very important part of the due diligence, like Dan said, for investors. Okay, so moving on here, we wanted to talk a little bit about some cap table best practices for you guys. As you get into, managing your cap table, the first thing that I tell the founders that I work with is make sure you have a good startup attorney. I can't tell you how many times a founder wants to try and scrape by and they're using like their brother-in-law who just graduated from law school because he knows the law. Startup law is very different than other types of law, and make sure that you have an experienced startup attorney that gets it. It's going to help you out from the very beginning to set things up right, to do things accurately and correctly from the beginning, and set you up for success early on. So can't emphasize that enough. Make sure you get a good startup attorney. The other thing that I'll mention is do things early and do them right from the very beginning. So again, a good startup attorney is going to help you with this, to set things up properly, walk through, what are your plans for your company, kind of looking forward, making sure you've got things set up at the beginning to make the most sense. Dan, maybe you can talk to this a little bit about, I know there are horror stories about people missing out on, qualified small business stock and the tax benefits there because they didn't set things up right from the beginning. Would love to see if you've seen some of those types of issues.
Absolutely. So, as Jeff pointed out, there's a lot of benefits that you can take advantage of if you're doing things right from the very beginning. One of those rules is qualified small business stock rule. It's a tax rule that it's Rule 1202 if you want to talk to, a tax advisor about it. But what it allows you to do is if you get stock in a qualified small business, hold it for 5 years, then when you go to sell it, you get a 0% capital gains rate on the taxes of the first $10 million in capital gains from that qualified small business stock that you just sell. Again, you have to hold it for 5 years. So if you don't qualify for it from the very beginning, you're going to potentially shoot yourself in the foot. And have had a lot of clients who start their company as an LLC thinking that that's going to be the cheapest way to do it, or they have an accountant who's not familiar with startup law who advises them to do that. And LLCs don't benefit from Rule 1202. So there's a few different things that if you're not doing it right like that, then you're hurting yourself. And just keeping track of things, making sure that you have documents signed so that if there is a potential breakup between founders, you've got a vesting schedule that's been signed. It's very clear how much shares the company is able to get back from them. And it's going to solve a lot of problems before they even start. So that's, again, a lot of nightmares to not doing things from the get-go, or doing them wrong from the get-go that hurts you.
Yep. Yeah. I mean, there's a lot of sad stories around things like that where people end up paying a lot more taxes, or things happen down the road that they could have prevented from doing things correctly right from the beginning. So kind of along those lines as well, is a good startup attorney is going to help you keep things simple. Again, this is something very important as you start to go down the path of raising capital. The last thing an investor wants to see is some weird term or some weird structure that they're not familiar with. And a good startup attorney is going to know what's standard and what is, how to set things up simply and correctly. Just to set you up again for success if you're going down the path of raising capital. So keeping things simple, and then using software instead of paper. I mean, these days, you don't have to issue paper stock certificates and have everything physically signed. I remember going through a transaction with the company when we sold our company, and having to physically go into the attorney's office and spend like 3 hours signing documents. You don't have to do all that stuff today. You can do a lot of this through software, including issuing, stock and keeping track of everything right through the software. So that's kind of where Carta comes in, and Savvi as well, in keeping track of everything and having a platform that really helps you out as founders. Okay, so Dan, I wanted you to talk a little bit about SPVs as well, and some cool things going on in the startup space.
Yeah, thanks, Jeff. I think that this is something that we're seeing come in really a lot with frequent transactions, with recent transactions, especially companies who are doing financings on a periodic basis, once a year, once every 6 months. What an SPV is, it's a special purpose vehicle, an entity formed for a special purpose, which is to invest in your company. And when you have a lot of people that are coming in on a round, let's say you're doing a friends and family round or an angel round, seed, pre-seed, seed plus, whatever it ends up being, you can use an SPV to simplify your cap table, because what an SPV does is it brings in all of the investors that are in a round. They put their money into one vehicle, one entity that then invests in your company. And then on your cap table, you're just showing one line. It simplifies your life. It simplifies the investor's life. And so that's what an SPV, sometimes you hear them called roll-up vehicles, RUVs, but they're very common these days. You'll want to look into that when you're doing your rounds. Does it make sense to use an SPV to keep your cap table clean? Go ahead and pull up the next kind of piece here. Again, it lumps multiple investors into one line item on your cap table. A company can form the SPV themselves, or if you're raising from an angel group like, LA Angels or, Valley Angels, some group of syndicated investors who are coming in kind of as a group, you can ask them to form an SPV and to syndicate all of their investments into one vehicle. But yeah, it's definitely in your best interest. There's multiple ways you can do it. And the next bullet point talks about, you can just set up a standard LLC, just form an LLC, people put their money into that LLC puts its money into you, or you can find somebody who has a series LLC where you can form these series for each investment. Some companies are actually forming their own series LLCs so that every round they can create an SPV for their investors, and it keeps their cap table very simple. The series LLC allows you to do it with reduced maintenance fees, reduced filing burden, keep track of everything a little bit more simple. But that is what an SPV is. I just wanted to touch base on that. Very common these days to see SPVs popping up to keep your cap table clean.
Yeah, we're seeing a lot more of that. Especially as you're starting to get into equity crowdfunding and some of those things, and you're seeing that be a great vehicle for things like that as well. Awesome. Okay, so I want to make sure we leave some time for questions here at the end. I'll just quickly go over, what Carta is. We talked a little bit about, or we've heard it referenced a little bit, but Carta is a software platform that helps you keep track of your equity. You can issue your stock right through the Carta software platform. It helps you to be able to model things out, kind of as you're trying to plan out future funding rounds, things like that. Having all of this in a software platform is super beneficial for you guys as founders. So this is an example of the Carta platform. It just keeps track of everything, including vesting schedules and everything else. Carta also provides 409A valuations as you guys start to issue out your stock options. Also keeping track of things like board management stuff, and then liquidity tools as you guys kind of get to the point where you're looking for liquidity at some point. So we have a special offer for the OneValley community here. Carta actually has a free platform. I'll go back here. It's free for companies that have raised $1 million or less and have 25 or fewer stakeholders that don't need a 409A valuation. So if you fall into that category, you can start using the Carta software for free, and it allows you to model out your safe notes or your convertible rounds and do all kinds of stuff within the software. Once you do reach any of these, or you need a 409A valuation, there is a first-year discount available to you through OneValley that we can make available, and we'll also waive the implementation fees for you if we're implementing your existing cap table over to Carta as well. So wanted to just kind of leave you with that in terms of Carta. And Dan, I know you had some things to share about Savvi as well.
Yeah, I'll go ahead and just share my screen really quick here. And so want to introduce people to Savvi and what Savvi is. Savvi is actually, we're not a law firm, but we are a technology platform that companies can take advantage of. We put together the platform with founders and lawyers and investors in mind, with the understanding that, hey, there's no system out there that allows you to streamline, integrate all of your legal in one place. And so we created a connected legal platform to be a tool that all of these different stakeholders can take advantage of. I'm not going to spend much time here because I do want to get to the questions, but this is what the Savvi platform is. It combines kind of a task management system, keeping track of documents that need signed, state filings that you need to do, all of those types of legal tasks that are very hard to keep track of. So we can keep track of that for you. We provide a template and workflow library where you can get access to our automated transactions. And so when you're going and you need a template for something, we have templates for it. We can do entity formations. We can do safe or convertible note financings, including the board and stockholder consent documents that you need to have. But it's much more than that. We can do NDAs. We can do your master services agreements, independent contractor agreements, employment agreements. We have workflows for these. And so we are a transaction management platform as well that includes automated templates. And then we also serve as your data room. So anytime a document is signed, we will pull it into your data room. You have to keep track of that. It will build your data room for you so that you can share it with your investors. And we create these reports for you to be able to see, okay, where are my legal documents? What do those relate to? And so that is what Savvi does. We actually have a deal, as has been communicated. We have a deal that you can get $1,000 credit towards your Savvi account to be used for different things on the platform. you can go ahead and schedule a time with somebody on our onboarding team using the QR code. Somebody from our team can also share that link. But that is Savvi. We want to give you guys, I'm going to turn the time back over to the Q&A section here. I'm going to pull up some questions, but want to allow you guys to take advantage of that perk that you get through OneValley, the passport there. You get to be able to take advantage of some of the workflows on Savvi and use it. I will mention, we have a workflow that allows you to set up a Carta account. And so if you have your documents on Savvi, you can submit a Carta account setup request, and we can actually push your equity data, your equity documents onto the Carta platform so that you have that set up through the Carta launch offering. So working very closely with Carta, making sure that you can take advantage of the Carta tools. All right, so let's open up the Q&A section here. I know that there's quite a few here.
Before we do that, I was going to just say, I just set up a company. I don't know if you know this, but I used Savvi to just set up a company for a friend and went through the whole process, and it was awesome. It made it so much easier, and the documentation was fantastic. So kudos to the Savvi platform.
Thanks, Jeff. And I'll say we also use Carta for our cap table management. So Carta, for cap table, really there is no other solution out there. Carta, you need to have your cap table on Carta. It's got so many great tools. I've seen some people ask questions about, how do I know how much equity to give an employee member? They have a tool that allows you to check baseline option grant numbers for different positions. It's got a lot of cool features that Carta does. But anyway, hopping over to the Q&A. So we've got Torser Cody has asked, seems like the SAFE is very founder friendly. What motivates the investor to sign up for that? Great question. Really, the question comes into how heavily sought after is the investment in your company. If there's a lot of investors wanting to get in on the investment, then you can use a SAFE, because it is a founder's market for your investment. But if you're having a hard time in raising money, you might have to use whatever the investors tell you they want, and they might ask for a convertible note rather than a SAFE. So that's kind of up to the investors. Next question. Tools to calculate eventual dilution impact from SAFEs. That is something that Carta does. Carta has a scenario modeling tool. Jeff, I don't know if you want to talk about that.
Yeah, actually, it's a free tool. So even if you're not on Carta, you can, I think you just go to safes.carta.com or just Google Carta Safes. And there's a free tool that you can use to model out your safes and again, put in whether they're pre or post money safes, and even evaluate the difference between whether you do a pre or post money. So I mean, it's a very valuable tool as you're kind of hitting that stage of your company.
Great. Marty Jensen asked, what are ways to navigate away from orgs like FINRA and SEC? So for those who don't know, FINRA and SEC are the United States regulatory agencies that regulate the issuance of equity and securities. Any investments, you need to make sure that you either register with the SEC or you qualify for an exemption from the SEC. In the United States, there is actually not really any way around complying with SEC regulations. If you're in the United States, you have to. Even trying to use Wyoming versus other states, Wyoming is subject to the United States regulations. And so if you're a Wyoming entity, you still have to comply with the SEC. LLCs have to comply with the SEC. That said, there are a lot of exemptions that you can qualify for, that most startups do qualify for, that make it easy to raise money through a SAFE or a convertible note. But you still have to make sure that you're complying with those regulations. If you want to take your services and your business and your investors and your employees outside of the United States, then you don't have to comply, but you'd have to comply with whatever country you do move to. So sorry to say that it's very hard to get away from those types of regulations as a startup. Are Biden's tax reform targeting ISO? Great question. I have not heard anything about targets to ISO or qualified small business stock rules. It could always change. It's always potential that could change. But right now they haven't mentioned it. I would actually be surprised if they do, because a move like that is a move that hurts startups. And anything that hurts startups would probably be bad for their administration. So I'd be surprised if their tax reform does target, startup-focused tax rules, but it's always possible that they do. What percentage can offer to new startup team, and what are conditions to stay in the startup if there's average years of commitment? Again, the amount of equity that you offer to a new startup team member varies based on what they're bringing to the team. It's highly negotiated. Carta does have that tool. Jeff, can you talk about that tool, the equity modeling tool?
Yeah, one of the advantages Carta has is the data that it collects. There's now over 20,000 companies using the software, and so all of that data can be aggregated, and you get some interesting benchmarking data that you can use to make decisions like this on how much equity to grant a new employee. The tool actually will let you detail out, is this an engineer, a finance person? What level are they? Are they a manager? Are they an executive? And it breaks it all out. And then it also will look at it from geography as well. So is the person based in San Francisco, or are they based in Salt Lake City or wherever? And so there's a lot of factors that can go into that. If it's, like Dan said, if you're kind of splitting up founder stock and you're bringing on a co-founder, there's as much of an art to that as a science. It really has to do with who's contributing what, and whether it's in the form of capital versus intellectual property versus connections or fundraising, whatever. There's a lot of variables that can go into determining founder stock allocations. So there's some good resources out there. Something called Slicing Pie is one that you might want to look into. But there, as you get into, divvying out equity for employees and things like that, there's definitely some tools out there, and Carta has some good data benchmarking info.
Great. So yeah, any of the questions on here that are asking about how much equity to give somebody, what are good, ways to find that out, the Carta equity benchmarking tool is the best resource for that. There's a number of questions here about 409A valuations. So I want to try to answer those because there are a number of people asking about that. Does the 409A valuation usually equal the valuation of the most recent financing round? The answer is no. As Jeff mentioned in the presentation, this is a compliance valuation. It is not tied to the valuation you're giving investors. And so if your company's not worth anything pre-revenue, you go and get a 409A valuation, it's going to be 0 or 0.0001, even though investors might be willing to invest in your company at that stage at a $2 million, $5 million, $10 million valuation. The 409A is not going to reflect that. And you don't even have to show the 409A to investors because it's completely disconnected.
One other point,
when should you start getting?
Oh, I was going to just mention that, the other way to look at this is you're valuing the common shares. So you have to take into consideration that your investors are going to be getting preferred shares, and those preferred shares are typically worth more, especially in the early stages of a company, than your common shares, because they'll have preferences. There's less risk, depending on what those preferences are. There may be, returns built into the preferred stock. And so it's very different when you're looking at your 409A valuation versus, the last preferred round. It should be significantly less in a lot of cases.
Exactly. And perfect point there, Jeff. If you raise money in a preferred round at $1 per share, you go get a 409A valuation right after that preferred stock financing, it'll usually value your common stock at much less, like 40 cents per share, 45 cents per share, 30 cents per share. It's going to be much less. And so it's just a good example of the fact that the 409A valuation will not be tied to your preferred stock valuation. It's going to be very different. And so you shouldn't have to reflect that. And again, you need to get the 409A as soon as your company's worth something, usually. Whatever point your revenues hit to make your company worth more than 0.001 per share, that's probably when you start getting a 409A valuation. And you can get that through Carta. I know that we've hit our time limit. I'm happy to continue answering questions, but I apologize for
it seems like we have a lot of questions from the audience. I'm happy to keep the room open for like another 5 minutes or so. If you guys if you have some really pressing questions that you feel like would be beneficial to the audience, happy to facilitate that. But yeah, we do need to wrap it up in a little bit. So just like maybe 1 or 2 more questions and then we'll call it.
Zach,
Great.
do you have any questions you think would be really helpful for the community that maybe we could address? Yeah, there's
so many to go. There's so many to go through here. So it's hard for me to speak to that because kind of like our community kind of comes from a lot of different places. So maybe you can speak to kind of like international aspects of startup incorporation. Like does it as well as like where you should be like housing your legal documents and things like that. I saw Dan on your on Savvi Legal's platform that you were kind of holding some documentation in maybe California or Delaware, or so maybe one step beyond that as well is like, does it really matter where you're signing these documents? Is there something to keep in mind there?
Great questions, Zach. I appreciate that. So from an international perspective on the cap table, first of all, you can sign documents from anywhere and they can be legally binding for a U.S. entity, for U.S. investors, for international investors. As long as the entity is a U.S. entity, in those, you can sign it from anywhere. It doesn't matter where you're signing it. Electronic signatures are enforceable like a hard signature in the United States. With equity, if you're giving equity to somebody internationally, then U.S. tax laws and securities laws would not apply to them. And so some of the things we've been talking about with ISO treatment, Rule 1202, they would not apply to somebody who holds equity from outside the United States. That said, if they were to move into the United States and then sell their equity after moving to the United States, then at that point they would be, U.S. laws would apply. Most companies that are looking to raise money from U.S. investors should plan on having a U.S. entity. U.S. investors want to invest in a U.S. entity. And so the most common U.S. entity for startups is a Delaware corporation. There are tax reasons why corporations are better than LLCs for startups, but that is the most common structure. And so something to look into. You can also use the SPV situation to your advantage, where you could create an SPV for international stockholders, international investors, or even use the SPV just for the U.S. investors. And so just some things to keep in mind. A lot of different ways to go. A lot of these questions are very specific, where you probably do want to talk to an attorney about some of these, especially if they're regulatory, tax-based, anything like that. You should probably be talking to an attorney to get specific answers with respect to your unique scenarios.
Zach, I think you're on mute.
Okay,
Yeah.
and I think we'll take one more question here from Doug Erickson. He kind of just sent it to our panelist chat. He said, how is the cap table impacted if companies doing Reg AE or equity crowdfunding?
Great question. And Jeff, do you want to talk about that? I'd be happy to if you.
Yeah, I can kind of kick it off. We're seeing more and more equity crowdfunding, which is exciting because the SEC came out and increased the limits on on the Reg CF stuff, where instead of $1,070,000, companies can raise up to $5 million under different circumstances. So you're seeing a lot more of that. But as Dan's been talking about, the SPV structure is getting more and more common there also. So that's also allowed by the SEC under these new regulations. And one of the challenges you had previously with crowdfunding is that it would kind of turn off institutional investors when you have a company that's raised $1 million and they have 2,000 shareholders on their cap table. Most investors were looking at that going, yeah, we don't even want to touch that. There's liability with having that many shareholders. There's all kinds of issues that can creep up. It just wasn't appealing. Where you can use the SPV structures now, that becomes less and less of a problem. And you're seeing that does become a legitimate way for companies to raise a round of funding, use an SPV and do an equity crowdfunding, and then from there go into the institutional capital if that's kind of the path you're going, and it's not going to mess things up. So you're seeing more acceptance, and I think my take is I think you'll continue to see more and more acceptance of that as you see companies take advantage of being able to equity crowdfund. The other thing I like about the equity crowdfunding is that you're appealing to a retail investor sometimes that might, especially if you've got a consumer products company, you're now allowing those customers to invest in the company and become shareholders, which is kind of a cool thought and a cool trend that I like seeing.
Great.
And I will add here on that when you do a Reg A or equity crowdfunding, you will want to make sure that all of those investors do come in through an SPV, because if you have 1,000 people, 3,000 people, 5,000 people in those rounds, it will be a nightmare and potentially unfeasible cap table that you will not be able to manage. It can get out of control with the number of people that can be investing in your company. So you need to make sure they're doing SPVs. Most crowdfunding platforms do an SPV for you, but just something to keep in mind.
Great. Thank you so much for answering all those questions. We have a ton more. As you saw, for the attendees that stuck with us through the gauntlet, thank you so much for being here still. I know that Rachel from Savvi Legal dropped like a meeting in chat, as well as the Savvi Legal website. So if you want to check out more information there, feel free to check it out on their websites and ping either Jeff or Dan or their entities to find out more. Jeff, Dan, thank you so much for being able to join us today. Learned a lot, and is incredibly insightful stuff that I think our community definitely needed, and are happy to have continue this conversation again at a later date. Thank you, gentlemen.
Yeah, I would love to do it again and maybe do a deeper dive next time even. So thank you for having us. Great to be part of the OneValley community. So thanks so much, Zach.
Yeah, and to all our attendees, thank you again. But yeah, we're going to call it here. So that's it for today, and yeah, we'll look forward to seeing you again.